and I'm also your host for today's webinar. We're so glad that you're joining us for this month's Lunch and Learn. Today, Graham's going to delve into a comprehensive analysis of what transpired in the economy and investment markets in 2023 and provide valuable insights into what we can anticipate and expect in 2024. This webinar promises to be engaging and informative. And he's going to be offering you some key takeaways that can assist you in making some informed decisions as we look to the year ahead. It's a great opportunity to gain a deeper understanding of the economic trends and how they might impact your business and investments. As always, there's going to be a Q&A session at the end of the webinar. So if you have any questions that you would like Graham to answer, just type those into the chat box and I'll make sure that he gets those and can answer them for you. And as a reminder, we do have Graham's calendar popping up periodically throughout the session. And if you would like to meet with him or anyone on our team, just choose the day and time that work best for you, and we'll get that scheduled. And with all of that out of the way, I'm going to turn things over to Graham.
Hey, thank you, Stacy, and thanks for everyone being on the call. I mean, we really wanted to do kind of the end of the year wrap up for 23 and the 24 kickoff after the new year to make it really something that's impactful and not lost in the holidays. So I really appreciate everyone with y'all's patience with us. I think this will be a platform. If the feedback comes back positive, we'll continue to go this way. But let's talk about it. Let's just jump right in and look at the figures. So right now we're talking about 2023. So I'm going to start off talking about kind of what really worked, what were the have-nots, if you might, for 2023. And then what do we expect for 24, the new year? I know we're already a bit in it. Not a lot has happened yet, but obviously things are going to unfold, and we'll go over each and every one of those that we think are going to be of pertinent to your investment accounts, portfolios, the economy, things like that. But let's talk about 2023. So we'll get into the indices. How did they perform? Why did they perform that way? Because it was a very concentrated focus on what worked and then what didn't work. And that's why I get into the haves and have-nots. Then we'll get into kind of wrap it up kind of with Fed policy, because that kind of drove 2023. The anticipation that the Fed will pause and maybe lower in 2023, we thought that was a little bit ambitious, but the market didn't care. It just took off. 7 stocks making up 75% of the return of the S&P out of 500 total names that make up that indices. Pretty interesting, but I'll get into that in a little more detail. So let's see where everything kind of wrapped up for the year. So we saw the S&P, the Standard & Poor's 500, which I generally call the market. That's 500 stocks. That is a cap-weighted index. And the reason why that's important is a cap-weighted index, a higher weighting will be to the companies that have a higher capitalization. So for instance, Apple, roughly a $3 trillion company, 7% of the S&P index. Microsoft, NVIDIA, Netflix, Meta, so on and so forth. So the larger companies make up a larger weighting. So those 7 stocks of the S&P, those MAG 7, we'll get in that in a minute with the half, made up about 30% of the S&P's index in terms of a weighting. They accounted for 75% of the return. So I'm stealing some thunder from my next slide, but I want to leave that impression on you because it was a concentrated, for about 3/4 of the year, a very concentrated rally. And then it started broadening out from about Halloween on to today. So the Dow Jones, that is what's called a price weighted. So we've just gone through interesting thing that's gone on with Boeing. Horrible with the doors flying off, whatnot. But Boeing is a New York Stock Exchange, a Dow Jones stock. So the Dow Jones stock, it holds a higher weighting. So Boeing being down, 6-8% yesterday caused, the Dow to be off, or at least 100 points or more of the Dow pullback at any one point during the day. So when you're looking at these indices, it's important to look at, is it a company issue? Is it the index? what is it that's moving the market that day so we can right size our expectations, at least in the short run, if not the long. Then we get into the S&P mid cap, and the Dow was up about 13.7%, quite a bit less than the S&P 500. We saw the Standard & Poor's mid cap up about 14 and a half, and just under 14% for the small cap. Keep in mind, for the Dow, the mid cap, and the small cap, those returns right there, they basically all came from Halloween of last year, late October, 1st of November to the end of the year. And their performance outperformed the S&P 500 from that period to the end of the year. Then we get into the the NASDAQ, where the haves are really living, right? That technology, that consumer discretionary, anything named AI, or they talked about it in their conference call. That's a lot where they live, because that has a huge weighting in technology. And that was up huge, up 43%. Keep in mind also, the indices not necessarily hit new highs. Just now are we even talking about that? The S&P challenged it at the end of the year, but didn't. It was off 19+ % in 2022. It's up 24. So it really didn't quite hit new highs yet. I don't think it's official on that. And that's true across many of the indexes right here. So let's get into the haves and have-nots, So let's think about the haves. What were the haves? Money market funds, right? We couldn't make any money on our ultra safe money for the longest time. Why? Because the Fed kept interest rates so low, and we'll have a slide in a minute on that. They kept rates so low from the last, what I call a Great Recession or a depression that happened in 2007-9, that trend of lower rates, for a decade plus. You just couldn't make money on that. So you were forced to take on more risk with the stock, and if not the bond market, right? Mostly the stock market, right? So you couldn't. Well, what happened to 22? They raised rates so quick, so fast, right? The quickest pace we've seen in 40 years, outside of the late 70s, when at that particular time, we saw inflation, about 14%, and the Fed funds rate was about 20%. Quite a bit different than even where we're at, or quite a bit different than where we were even at in 22 at the height of inflation, which peaked out at about just over 9%. So yeah, it became an investable class, right? It became an option to invest in where you didn't have to take market risk, right? But keep in mind, even the money market funds yielding over 5%, the S&P did 24%. Even if you had to wait all year long to even make money in your diversified portfolio, because that was a bad word last year, right? Diversification. It was all about concentration in a few sectors and a few names. And it didn't really broaden out to the end of the year. That was a viable class. But even the Dow, the small caps and the mid caps returned 13, 14 odd percent towards it was Halloween, first part of November to the end of the year. So just a unique year, not unique that we get a concentration like that, but unique to have it that powerful among such a few, driving the market so much. So again, like I said before, 75% of the market return, was made up of, those 7 stocks, those magnificent 7 that we talk about, and they make up about 30% of the indices. So the S&P was up about 24%. So what was that area? It was that technology, best performer NVIDIA, Meta over communications, travel. The consumer played a huge role. They didn't give up. Right? Even though inflation was high, they still had a job. Wages were still reasonably strong, right? Or very strong. So as long as they had a job and their wages were there, and the house values, appreciated. Heck, they were spending money. They were traveling. So that's why Royal Caribbean, asset managers like Brookstone or GE had a very good year last year, and that was a few select in the industrial side. So now let's jump into the have-nots. What didn't work? Anything out of that last slide, right? So bonds didn't work. Why? Well, the assumption is that the market's going to start anticipating it. Yeah, they started anticipating maybe that the Fed's going to pause and lower, but the bonds didn't get the love yet because the Fed the Fed kept raising interest rates, right, into the first part of next year. They didn't really start pausing, and they haven't officially said pause, and never will necessarily, but they have paused to see the effects of the rate hikes they've already put in place. But that didn't really happen again until first part of November, October. And then you had that huge shift in the market. So we had bonds really underperforming. Diversified portfolios. If you're trying to diversify your portfolio, grab a little international and small and mid, not just have it in the Mag 7. You're trying to spread your risk out, which makes logical sense, right? That didn't work. That underperformed for, most of the part of the year. It didn't start to outperform until the rest of the have-nots started outperforming until the latter part of the year, the last 2 months. The equal weighted S&P. Now, the reason why I put that up about 13, just below 14%. So what is the equal weighted S&P? So think about how I gave you how the S&P is configured. The S&P is a cap weighted index, right? So I'm not trying to confuse anyone, but it's important to understand these things. So it works really well, like last year when those companies do really well, but what if they don't? That's something we want to be mindful of. What if we have years or a year when those top 7 don't perform? What would that do to the index? But let me get back. I digress. Back to the equal weighted. So an equal weighted S&P means no one company has a larger weighting than the other. They all have an equal weight, right? They all equal 1, equal 2, whatever that percentage would be. Instead of Apple at 7%, but XYZ company that's a part of the S&P maybe only has a 1% weighting. All right. Hope that makes sense to everyone. So when we equalize that, and you can go by the index, it's called the equal weighted S&P, and different companies offer that through ETFs and probably funds. But think about that. The equal weighted was only at 13.7%. That's all stocks, all game on, no other international, not necessarily, might have some small and mid in there, but no real international exposure and no bond exposure in that. So utilities didn't perform. Utilities are the classic of where do I want to protect myself? Where can I get good, strong income, maybe some dependability, maybe lower volatility, right? Where if the Fed starts to lower, and we're not going in a recession, hopefully, we don't believe so. I'll get in that in a minute. But where would you go? You would traditionally go into utilities, right? That doesn't work great when the Fed gets aggressive with rate hikes, nor do bonds. Bonds have had their worst performance ever in 2022. But yeah, that's a classic place that you might see some money start to go into, but that didn't work that way, right? Everyone loved tech. They loved the AI, and they were staying with that trade. Consumer defensives, right? Like Dollar General or Moderna. Moderna was with Pfizer. Some of the, the plays on COVID. Well, COVID was getting behind us, gone. We didn't want to talk about it. I'm sure if you're like me, it's the last thing you want to think about, even though it's still with us to a degree. But those didn't work, right? Healthcare in general didn't work. Oil and gas did great. 21, 22, just had a really poor year in 23. Right? Not surprisingly, usually when you have years of outperformance in certain sectors, it's not unusual to have them underperform, at least to a degree. But this was a pretty good underperformance. And Devon was one of those on that. And then we look at agricultural inputs, what feeds that system. That was some big underperformance for that year. So let's talk about the Fed rate policy, because this is kind of what kind of sets the tone here a little bit. I'm going to do some drawing, bear with it. I'm going to play around with this on today's call. But this is where I was talking about 7-9. This is the recession, what I call the Deep Depression, where the Fed funds rate was about 5 and change, right? Now I'm going to go back to this in a minute, so remember why I made a comment on that. Look what happened. What does the Fed do? The Federal Reserve policy or mandate is price stability, employment price stability, right? How do they keep a good, consistent pattern to our economy, hopefully in a positive where it doesn't overheat and it doesn't underperform, right? So they're going to mess with different instruments to kind of regulate a little bit that. And interest rates are one. So what do? They lower interest rates to encourage borrowing, spending, to hopefully get growth back into the economy. And that's exactly what they did. 5 and change, about 5.5, drop back down to 0. And we went through so long at 0 rates. It didn't start going back up until late 15, 16, up to 19. And then what happened? Boom, the pandemic right here. So what do? Everyone's locked up. You're stuck in your house. You can't go. People are laying off. They didn't know what was going to happen. So what do? They lower interest rates again for borrowing, right? Let's get this economy up. Let's make sure it stays up. What happened? They stayed too long. And then all of a sudden they had to raise rates so much, so quick. What, 11 times the fastest pace ever in history, right? Not the most, but the fastest pace. But look, they basically just raised rates back to where it was. I know this horrible drawing, back to the great, I say, recession depression, right? So we're just getting back, and I know this is going to sound unusual for many, but getting back to a bit of normality, right? But it was the pace, not the fact that they raised rate. It was how quick, how fast. Drove the market down. Anything that's interest rate focused, like real estate, utilities or telecom, bonds, really took it under the chin. So did anything that was growth that had earnings in the future. So those Microsofts and Apples and everything that worked in 2023, definitely in the first 3 quarters, 90% of the year, wow, that took it on the chin. They were down 50, 70, 80, 90%, right? So that's what happened. And then right now, let me see if I can take this off my screen. So right now, maybe I can't, we're starting to flatten out. I don't know if y'all can see this, right? We're starting to flatten and we're starting to get into some expectations. And we're using, some of our peers have some great slides, some great, things they put together to help me kind of navigate this call. But you can see we're expecting those rates to start going down in 2023. But be mindful that maybe not as quick as the rest of the market might think it is. So let's go ahead and jump into 24. All right. So let's think about the economy and market moving events. What can move this market, right? What to expect. And then we'll talk about some investment markets. What do we think is going to work, right? Compared to what worked in 23. So what are the main themes that we think we're going to be dealing with, right? Geopolitical events. That's always headline events, right? And when I say geopolitical events, I'm talking about wars. What's going on in the Middle East that's kind of brewing now, right? What's going on with Russia and Ukraine? What else could pop up? These are always going to be things. It's not unique to any one year. That's going to be something we just have to deal with, right? Is it going to cause long-term underperformance in the market? I'll show a slide in a minute. Probably not, but it's still something that offers volatility in the moment, right? We got to deal with an election year, and everyone's got different opinions, and that's great, right? But it's an election year. And usually the questions I get, well, it's election year, right? So this market's going to go down. Well, not necessarily. I'll show you that. Then the federal rate policy, kind of where they're at, inflation, and then we'll get into unemployment. Because think about this, unemployment drives pretty much everything. If you're feeling good about your job and you're employed, the likelihood of you spending money is pretty strong. But if you're worried about your job or your pay's getting cut or you get laid off, you're probably less likely to spend as much or at all. You're going to tighten the purse strings. I think that makes sense. So it is, and it does play a role in how we think, if nothing else from a psyche standpoint, if not just a reality. So here we're talking about geopolitical events in the S&P index over time. And we went back to 1965, going back all the way to that period. And you're throwing so many things in here, from the bond market crash all to the Asia contagion to the financial collapse. We got the Paris attacks. We got the U.S.-Iran tensions. We got Russia invades Ukraine, so on and so forth. But the moral of the story is the market still marches on and the direction is still up. Yeah, we get the volatility here, here, and here. But the overall theme, we still move up. Think about this and what happened over that time. The Fed has been lowering interest rates all through that period. That's this green line. They've been consistently lowering interest rates over time, right? Even though we've gone through all this drama, unfortunate situations. Let's jump into the election year. I always get that. Well, the market can't do well in the election year. Well, any election year could change what's happened in the past, but I don't think history is going to tell you the market hasn't done well. If we look at the past, and we pulled up a couple different ones, excuse us if this is a lot on one page, but I kind of like them all, so I wanted to keep them. But we went back from 1920 to 1919 to 2019. And we basically said that during a new president, how are stocks and bonds done? Right here, stocks are in the orange or red. Bonds are going to be in the yellow. Look, new president, stocks are up 9.3%. Bonds were up 6.7. If we say, all presidential election years, it's still positive, 11.3% compared to 5.5 for bonds. We look at what about the incumbent? 13 compared to a positive 4 for bonds. I guess you get it. It's still a plus, period. Doesn't mean we might not have short-term volatility. I'm not going to take that out of the cards, and it might not work out exactly the same. Now, also down here, I said, how did the S&P just generally perform, right? And we said during election years, we throw off the numbers again, right? What if we break up and we have some division? What if the Republicans sweep compared to the Democrats? What if there's a division? It doesn't matter. Guys, it's still positive, right? So I want to get past some of the short-term drama that happens in the market, and we're presented with so much and bombarded with the news, and just kind of think that, hey, listen, at least in the past, it's trended positive. We'll just have to see if that continues to happen. Let's jump into the Fed policy, right? So what happens when the Fed ends, right? And then we'll look at 1 year, and then we'll look at 5 years out. And we can look at core bonds. How have bonds done, right? So we'll look at cash and cash equivalents, up about 4.7%, even positive 3.2. Listen, when the Fed pauses, it's good. You don't want the Fed to pause and start to lower rates dramatically, because then that might be there's a bigger issue going on with the economy. That might be that recession that we don't want, right? So we want the Fed to pause and softly. That's why they keep saying a soft landing here. You keep hearing those terms. But if we look at core bonds positive over 1 year, 5 years, you're looking at U.S. stocks all the way to a 60-40 stock, which is 60%, bonds 40%, all still positive. So I guess you're kind of getting the theme here. The moral of the story: I can't take out short-term volatility, but time tends to level the playing field a bit, kind of irons out the bumps, if you might. And we got bumps. I don't want to paint the picture that everything's rosy. That's not what I'm trying to do with this call in these slides. Let's also take a minute and kind of look at kind of where inflation's gone, right? So we've gone through the quickest rate tightening policy ever in history. We haven't seen it in 40 years, right? So we went through 2009. Rates flew up in 2021. Fed saying, hey, listen, we're late to the party. It's not transient, right? But we started to see food and energy and housing and all these things that affect our daily lives really coming down, and it's continuing to come down, right? Keep in mind that the Fed has a mandate at 2%, right? We're roughly on the core side about 4%, headline around 3%, right? So we got some more room to go. So maybe they keep rates higher for longer. Maybe we go from a period of really like low rates, like close to zero, to maybe more in the 2-3 range. Maybe they just say higher for longer. That might not be bad for the markets. At least history shows it's not. So here, let's kind of wrap it up here with the last couple of slides. We got historically low unemployment. Listen, we're unemployment 3.7%. Even when on this slide over here, we had CPI so hard, we didn't have huge layoffs. We were still roughly around the 3.7, 4% range. I think we topped it for a short period, just over 4%. This is great unemployment rates. No, I mean, you always want zero, but it doesn't really go to zero. So these are great, so yeah, we're still in a very, as inflation's coming down, we got really strong unemployment. We got the consumer still spending. Earnings hopefully will continue to be there for companies. Maybe not growing at projections of 11%, maybe close to 5 to 7. That would be good, so we don't overheat. We don't have to worry about the Fed stepping back in with rate hikes. So I think we'll get that moderation, right? So when I'm looking at 2024, I think it'll be a more moderate year. I always hope it's going to be just as good of the year, but I hope it broadens out, right? And we're starting to see that. And I think we continually will see that. So I think it'll be a moderate year, maybe not as good, but a good year. I think the have-nots have an opportunity to really outperform. We're already seeing that. We saw that the last 2 months of 2023. We're already seeing in the short period of 2024. So we expect to continue to see bonds outperform. We might see bonds outperform from a relative risk reward standpoint stocks. Why? Because when interest rates go down, bond prices go up. Think about that seesaw on the playground. One side being principal, the other side being interest rates. Interest rates come down, bond prices go up, right? And it's not a one-for-one, but that's generally the direction of how it happens. Then I think the dividend-focused area, that tends to be more conservative, areas. The small caps, which dramatically outperformed large caps, trading at a lower multiple, lower valuation, right? If we think things are rosy, then people are going to pile back into small caps. They dramatically outperformed at the end of the year. Not surprised to see them give up a couple percent at the beginning here, right? So again, a period of digestion is not unexpected right now. Energy, utilities, financials, healthcare, international markets. Keep in mind, international markets have underperformed the U.S. markets. I get it, decade plus, it seems like. But what if they start to outperform? They tend to trade at maybe a third of the valuations of U.S. equities. You're right. So maybe it is, if you don't have exposure to that, maybe we want to be mindful of that, right? I'm not going to say an overweight, but we want to have exposures to the areas, not give up and just focus on what worked in the past. Maybe we want to continue to think about, okay, if it's a good company, they got good earnings, they got a moat around them from competition, and they get cash flow and good management. To me, that's hallmarks for having a position in the portfolio from an individual stock standpoint or some sectors. Last but not least, let's wrap it up. And I know we got some Q&A to run through quickly. Conclusion, I think we got a slowing economy. We have to get inflation down, but no recession. I think we have modest returns compared to 2023, but good in an average annual standpoint. Maybe it's 7 to 10%. Maybe it's higher. We'll just have to see. Providing bond market performance, we think that's going to be the outperformer. We said the Feds will start to lower interest rates. We do not feel the Fed's going to lower 6 times. We think the market's ahead of itself. It's ahead of its skis on that, leaning too much. We think the market has to digest that overreaction in terms of getting too aggressive. I think the Fed's got 3 in the cards, and maybe it happens more towards summer to the latter part of the year, right? And the moral of the story is don't fight the Fed. I love the picture. So don't fight the Fed if they're lowering rates. That can be good for bonds and stocks, the market in general. Certain sectors outperform others that love lowering rates. So we just want to be mindful of those if you're trying to get real kind of particular inside the portfolios. Stacy, do we want to go ahead and open up this to a little Q&A?
Yes, sir. I do have some questions. The first one is, I've heard that the Fed is going to lower interest rates at least 6 times. Mm-hmm. Do you think that's going to happen?
Well, I think I kind of left with that. No, I don't think that's going to happen. I'm not saying, anything could happen.
Right.
I don't personally think it will. Let's be careful that we don't want something to happen like that. If they start to lower six times, that might mean there's a bigger issue. There's a bigger slowdown. There might be a bigger or a recession that they're trying to protect or protect us from. And that would be a bad thing. That might be good for bonds, definitely certain sectors of bonds, but not going to be good for stocks. At least those high growth areas that outperform the most, so on and so forth. So be careful what you ask for. How about let's just take 3 and be happy with it, right?
Okay. Are any companies included in more than one stock index?
Yes.
Okay.
Quick answer on that one, right?
All right. Do you think that the current stock market is overpriced?
I do in a relative sense, right? Now, that's relative, right? In the long term, what does it matter, right? 3, 5, 10 years, 2 years, whatever. It doesn't really matter. Right. But we do look at things, and I sent out a video out. I think it was our last weekly, not our last weekly wrap up, but the one before at the end of the year. And we see the S&P oscillator trading above 4, trending above 7. Anything that's not negative on that oscillator gives us an overbought signal. It's been overbought for a long time now. I think the valuation on the S&P is about 20, 21 times forward earnings compared to the equal weight S&P that might be trading around 16. Remember I talked about that earlier? I think small caps have quite a bit lower valuation, even mid caps than large caps, especially those Max 7 that I think are averaging over 30 times forward earnings. So again, it depends on the stock, it depends on the sector and your time horizon. But to answer the question, I do. Do you think the market's a little overpriced? Maybe just a pause that refreshes. Doesn't have to be dramatic. Maybe it's a rotation within. Maybe it's all of the above. So that's why we're saying, yeah, don't get crazy and overly aggressive. But if you got new money, start to deploy it into weakness. There's always opportunities, even in a market that we think might be a little over.
Okay. And I have one more for you. If we don't get a recession this year, do you think that we'll get one soon?
Well, I guess soon's a relative statement, right? What is soon for some is a long time for others.
Right.
Well, yeah, I think you have to expect recessions, right? So, I mean, we've had 10 recessions since 1950. They're not uncommon. They're a refresher, if you might, to the economy. They're not always appreciated. I get it, but they're not always deep, right? You could have a light technical recession. I've said this for 2 years. Everyone's been calling for a recession. And I think, listen, we've been on camera, we've been on film, we've been writing, talking to clients that we don't see it. It's not happening. I don't see it this year. We will, but maybe it's not a deep protracted one. Even if we got one this year, meaning 2 quarters of negative gross domestic product, I'm not going to say we couldn't. It might be a technical, maybe more for the academics than it's one that we really feel or notice until actually we're out of it. So we will. I just don't know exactly when, but I wouldn't plan your portfolios around a recession. They're going to come and go, right?
All right.
You got it.
Well, thank you so much, Graham. This has been a really good look at what we can expect these financial markets to do in the year ahead. And thank you to all our viewers for joining us once again for our monthly Lunch and Learn today. Please remember that you can always find our most current information, like our weekly wrap-ups that Graham's mentioned, and these webinars on our social media pages. And that includes Facebook and LinkedIn, sometimes Instagram. We invite you to stay connected with us as we continue your financial journey. And thanks again for spending time with us today. We hope you have a great afternoon. Take care.
Take care.